In volatile markets, traditional Bollinger Band strategies are great, but there is a specific stochastics combination that changes everything. What I'm about to show you turned my success rate from barely going above 20% to now above 60%, especially during market volatility where most traders struggle. I've spent over a decade perfecting this strategy through hundreds of trades for me and my students, and now use it in my setup for my end of day trading. While other traders were getting chopped up in a sideways market, this strategy helped me spot the highest probability setups. So let's get into the chart. The strategy is very simple. We're going to start this off as an end of day. We go to the daily time frame. Now you have a Bollinger Band and you have the stochastics. Now I prefer to use smart charts. Any other trading platform will have these tools. These tools have been around forever. And in this video, we're not talking about what these tools are. I'm just going to show you how you can combine it together and make a simple, profitable trading strategy. So how it simply works is you want to look at where the market is overbought and oversold. So the stochastic has an 80 level here and a 20. If the market goes above 80, as we can see here, that means the market is overbought, which means selling could be coming next. And if the market is below the 20, that means the market is oversold, which means buying could be happening next. Now, we are not just trading purely off those stochastics, we are combining them together with another indicator, and that is the Bollinger Band. Now, here's the important thing you need to understand. What we want to focus on is if the candle or the bar touches the upper band, we look for sellers. If the candle or the bar touches the lower band, right, we look for sellers. But you need to have the upper band and the stochastic overbought with a candle touching it. So let me explain. Here is a clear example. So as we can see here, this candle touched the upper part of the bar, and you can see the stochastic was in overbought territory above 80. So simply, when this bar closed, which was on the 6th of December, on the 7th of December, you would have placed a short on the next bar open with a stop loss at the top of that bar, maybe a bit higher, and you would have sold. And if you wanted to do a one-to-one, you measure the size of the bar that touched the Bollinger Bands, clone it, and that would have been your one-to-one target. So essentially, you would have put your stop loss here, your sell entry here, and your take profit here. So as you can see, that was a winning trade. Now that would have taken 1, 2, 3, 4, 5 days to potentially make money. Now after that, has there been a signal since? So has the market touched any of the lower bands? And has the market been oversold? So the market has been oversold, but the strategy requires that it has to touch the lower band. And as we can see, we came in overbought territory, but it hasn't touched the upper band. So if we go a bit further back, we can see it touched the upper band, but the stochastics were not overbought. We touched the bottom band, but the stochastics just went into oversold. We want to be in the oversold. Okay, so let's look at this example here. We can see the stochastic was oversold, which means buying momentum could be coming in. Which bar touched it first? So you could have used this bar, okay, as a potential buy opportunity. So you could have put a pending order there, and your stop loss would have been here at the bottom of that bar. Now you would have not been triggered in until 1, 2, 3, 4, 5, 6, 7, 8 days in, and then you made money 3 days later. Simple, right? The most simple, effective end of day trading strategy. When there's volatility in the market and the market has a clear direction, this simple end of day strategy is very, very easy to do. Anyone can do it, beginner, intermediate, or advanced. Now, if you want to take it advanced, you can add other elements into it, such as looking for things as bullish or bearish divergence, incorporating candlesticks, using support or resistance. These are additional things you can add. But if you can get in the simple habit at the end of day, just scanning what's touched the upper or the lower part of the Bollinger Band and what's in overbought or oversold territory, combining those two simple indicators, you can make a simple winning trade. So let's say we look at another currency randomly. And as we can see here, just generally looking back here, market touched. You put a pending order of the low of the bar, and the stochastic was oversold. Now, in this case, what we're doing is we are saying if the market goes lower than this bar, trigger us in. And look, it went up, up, down, then we got triggered in. So we would have been able to not get stopped out here. And it's the same thing with the GBP USD trade I showed here. Even if you triggered on the next entry, if you put a pending order at the low of the bar, you still would have won, regardless if it went higher than the stop loss. It's just a simple end of day trading strategy. Now, what I want you to do is to go and practice this and go find opportunities yourself. Now, look, as we can see here, market has now touched the bottom of the Bollinger Band. Market is oversold. And what we're going to do here right now is place a live trade. So we're going to go off this bar that's touched. Now, what I'm going to do, I'm going to place a trade, an actual live trade. So let's remove this line and I'm going to buy. So my buy entry is off the high of the previous bar. So here I can just go, look, previous bar high, and which bar I can choose which bar, that bar. My stop loss is on a bar high, which bar, actually bar low. So I can make sure I get it perfect off the previous bar. And whatever that measures, that's 88.7 pips. Take profit. Or if you want to, just go reward to risk and do a 1-to-1. And as you can see, I'm risking 2%, which means I can potentially make £893 on this trade, or I could lose £893 on this trade. And we placed a trade. Now, I sit back and let this trade do its thing.
So let's go through the rules of this trading strategy. So number one, right? If we want to be a buyer, okay, we want stochastics oversold, which means we want to be below the 20, okay? Below the 20. Step two, right? A bar or candle, right? Touching the bottom of the Bollinger Band. Okay, so what that looks like, if that's the band, right, market has to be going and touching. Has to be touching, okay? So 1, 2. Now, number 3, what you're going to do then is, to enter, you take the candle or the bar that's touched it. Now, if we're buying, you're going to put a pending order. So if you don't have the smart charts, you're going to be putting a buy stop at the high of the bar that touches. So what that would look like is this. If that's the bar that's closed and the new bar opens, your entry is going to go there. Your stop loss will go here, and your take profit will be whatever that measures. So it should go up like that. So we're putting a pending order. So even if the market goes down, then goes back up, where most people get trapped because they try to get that perfect trade, this is where you put a pending order of a buy stop so you can protect yourself from feeling that horrible emotion of getting stopped out. So that's if you want to buy, right? Now, if you want to sell, it's the opposite of everything. So if we want to sell, we need the stochastics overbought. So one thing, stochastics overbought. You can see that. Basically, the market above the 80, okay? Step 2, right? The bar or candle needs to touch the top of the Bollinger Band, okay? So 1 and 2. And number 3, the bar that touches it So if this is the bar, you're going to put a sell stop once that bar closes on the bar low. So it's a pending order. Your stop loss will be here. Whatever this measures, let's say 100 pips, you're going to put a take profit of 100 pips. Okay? So that's the rules. So if we go back now to the chart quickly, you can see we've taken a buy trade here. There's a pending buy on the high of this previous bar. Stochastics are oversold. This is the bar that's touched it. So I've got a high of the previous bar entry here. And when the market goes up, it'll trigger me in, potentially make me a buy.
Future Suk here. That trade I entered on the Euro Aussie on the 12th of February, around about 10 o'clock at night, I'm excited to tell you that it moved 88 pips and has made me over £800 in a single day. And just to remind you, remember the trading strategy. If it touches the bottom of the Bollinger Band with a bar and the stochastics are oversold, you place a buy on the next bar. You place a buy on the high of that bar. So when the next bar opens, it should go up and trigger you in when it takes out that previous bar high. And as we can see now, Euro Aussie is now touching the Bollinger Band. We're going to wait to see how that bar closes tonight, and stochastics are oversold. There could be another opportunity for you to sell. Now here's the crucial part that transformed this from a good strategy into a great one, and it's something I learned the hard way. You need to avoid trading during sideways markets, and I'll show you exactly how to spot these periods in this video here, so go and check it out.